All right, so 6 ways to reduce self-employment tax. And obviously a lot of these are probably almost a course in themselves, so I definitely want to make sure that we get through these. So number one is obviously legitimate deductions. And that means that they've got to be quantifiable. That means you've got to have receipts. And a lot of times clients say, well, I know I spent this money. It's like, well, your job as a sole proprietor, as a business owner, is to make sure you are able to prove these deductions. You don't want to take deductions that you can't prove, because that's just going to get you into trouble with the IRS. Documentable. So, they're legitimate ones that you can prove and that they make sense for your business, that you're not, if you're an outside salesperson who's going around selling, then, buying a big screen TV to watch the news probably not going to work. Qualified retirement accounts. This is number 2. This is a big one. It could be something like they have some self-employment, because if you're an employer, you offer things like 401k to your employees. And so if you're self-employed, you don't necessarily have an option for a 401k. There's a simplified employee pension is a SEP IRA. And then there's a simple, which is another type of IRA, which is and then a solo 401k. These are all options that are for the self-employed, depending on what kind of business you have and whether you have employees who are working for you. But these are definite things that can lower your self-employment tax, because they're a way to, put away money for the future and deferring some income, but it also is there to help you out, year to year on taxes by lowering your profit, so you're not paying as much in self-employment tax. All right, and then capital investments. And a lot of people are like, well, this is what gets people in trouble, but it can also be helpful. When you've got capital investments, you are buying some equipment for your business. As a side business, I own some vending machines, and so I purchased 3 vending machines when I first went into the business, and I, wrote off one completely, took the 179 deduction. I also did half and half with a 179 and a depreciation of the other one. And then I did the straight depreciation for the third machine. So I had a little bit of deductions going forward the next few years. You want to be careful, though, is that a lot of people think, oh my gosh, I made a lot more money this year than I thought, and I'm going to go buy a whole bunch of stuff. If you're depreciating that income, if you're not just 179 expensing it, if you're depreciating it, I don't want to call it, I put a penalty on here, but really it's just a method of depreciation that you have to be aware of, that if it's the mid-quarter depreciation, you're going to be getting less of a deduction than if you spend the majority of your money earlier in the year. So you want to just be careful and be aware of that. And then health insurance deduction. There is a self-employed health insurance deduction, which can lower your self-employment tax. And then, as I mentioned earlier, you can form an S-Corp where you can hire yourself and then, unfortunately, you can't fire yourself and collect unemployment, although you do have to, pay into unemployment. Unfortunately, you can't do that, but you do have that option to eliminate the self-employment tax and pay yourself as an employee. And then on your salary, you're paying into Social Security and Medicare and all that throughout the year, so you don't have to get that big hit at the end of the year. And the final one there is, deferring income, which is a little bit risky. If you're I would hearken back to our Tyrion, the IT, Brother Shadow IT. If he wanted to, he gets paid throughout the year. He could even tell his employer, look, could you just send, and if they're willing to do this, they could decide to send money the next year. If you're really close to moving up a tax bracket and your next year you're not going to have so much growth that you're going to jump into another bracket, you can do this. I don't recommend this, but for some people, it might be something that you can do. So there's just some other considerations that I think that are sometimes overlooked when people are planning their new business or getting into their new business. And this is capital investments we just talked about a little bit, but the expensing of goods, things that you're buying for your business. There's especially with the new tax laws, they're increasing the amount that you can expense. You're looking at a deduction on your income. So say you buy furniture for a home office or things like that. Everything that you spend will lower your profit, and so thus it lowers your taxable income that's subject to self-employment tax. So capital investments are something that you need to do in most businesses. You need to invest in something that is going to be usable for more than a year in your business. We're not talking about investing in paper or erasers or something like that, flash drives. We're talking about things like computers or a car or anything like that you can expense or depreciate. The home office deduction, which definitely is going to have some changes coming up with the Tax Cuts and Jobs Act. But when you've got a home office, you're able to write off things that you're normally not able to write off any place else. That's things like homeowners insurance, your utility bill. Okay, so even home internet and your cell phone or a landline for the office, as if some people might have those still. So those are things that you don't get to write off the entire amount of what you're spending on that. But if you do some home improvement or if you renovate the office, you get the percentage of the home office that is strictly for business. Now, you can't have a treadmill in the office, and because if the IRS comes knocking at your door, you're not going to be able to get it out into the hall quick enough. So you got to have a space that is only for business, and it can't have the family room. You can't I do some freelance writing, and if I write at the table down in the dining room because I want to be near my family or whatever, that doesn't necessarily mean that that's a home office. I have to have a home office that is specifically where I keep my filing cabinets and I keep my records and I'm doing all that business type stuff in that area, and it's not used for something else. One thing that a lot of people, I've had customers who, they had a huge loss, and then they're giving me all their home office deductions, and they're telling me, why can't I, how come every time I keep giving you this more information, it's not lowering my, it's not giving me a bigger refund, or it's not doing anything? Because the home office cannot usually cause a loss on a tax return. So usually, and there are ways to carry forward, deductions and losses, or expenses for a home office, but you can't take a loss like we talked about with the presumption of profit 3 out of 5 years. This is another fail-safe that's in the IRS tax code where if you have expenses and then you have a home office, you can use that to lower you to zero and zero profit, but you can't take a loss. Spousal income. A lot of people forget that if you're a married filing joint taxpayer and you are filing a joint return, the spouse's income is also going to be a part of the calculation of your taxes. And we all know that when you're just doing a married filing joint return, but a lot of clients who are self-employed, they don't always think about their spouse's income and what kind of an effect that's going to have on their tax bracket, on their, how many deductions they can take. And that's something that I think is probably one of the more overlooked entrepreneurial planning sessions, is thinking, okay, well, my wife does this or my husband does this. How is that going to affect? And so when I sit down with my clients and I meet with them, I say, for the Roose Bolton, the guy who did the off-road track on the weekends, his wife at some point in the early years didn't work, but then she got a full-time job, and that was affecting how much, his gross income was. For not only he had a W-2 job, she had a W-2 job, and that bumped them up to a higher tax bracket, and they weren't quite prepared for that. So that's something that I think is an important point to bring up to your client as you go through this. Medicare surtax, I don't think this happens to everyone, but it is something that you want to be aware of. I think there's a link that I can put in the that explains the Medicare surtax, but that definitely can have an influence on it's an additional tax for Medicare depending on your income level and where you're at. And I've got a good resource link for that can help someone out with that. All right, and that's I think that at this point, I think, Jeff, if you have any other questions, but basically I just wanted to, I think we got through everything that we needed to right now.
Yep, perfect. Thanks so much. That was a great session, and we appreciate you being on. Here are some ways that you can get a hold of Mark, that you can contact him. Also, there's the Canopy community where you can connect with other tax professionals and other folks to ask questions and specifics and things like that, as well as other courses. We've got a lot more courses on everything from independent contractor versus employees all the way through a very exhaustive course list on how to file and know when to file which 1099 forms. So we hope that you will take those, and we appreciate you taking the time today, and we'll see you on a future presentation.